Hi, my name's John Jagerson. I'm going to be your guide through the options education here. I'll also be one of the contributors to the daily articles and videos here in this section of the site. You can reach me, by the way, through the forums if you'd like any clarification or if you have questions. I'm available there. I'd be happy to help you out in any way that I can. So we're going to start out with an introduction to options. What are they? How do they work? This is going to be helpful for traders who don't have any experience in the options market, stock traders who are trying to enhance the returns, control risk and volatility in their portfolios, as well as those of you who are looking to be able to actively trade options. So let's start with the beginning. What exactly is an option? How does it work? What does it actually do to the investor? So options really convey one thing. This is how they get their value. They give you rights. So if you are the buyer of an option, you acquire the rights to do something. So now what that is depends on what kind of an option that you're buying, and we're going to talk about both kinds. In fact, specifically in the stock option market, the most frequently traded option by far are vanilla options, which consist of calls and puts. So the calls and puts are very similar in a lot of ways, and we're going to talk about how they're similar, but in addition, how are they different? What do they do that that can help you as an investor, whether you're trying to take advantage of a rising market or a falling market? So one of the takeaways here, and probably the takeaway from this particular section, is just to understand in what condition would you want to buy one of these options. So calls specifically are purchased when the market is going up. So if you are speculating that the market for a particular stock or even a market index is likely to rise, you're going to want to look for calls. Well, the exact opposite is true if you think that the market for a particular stock or even a market index itself is going to fall. You'd be looking for puts. So puts you would be using in the same kinds of conditions that you might short a stock. Now, by the way, it doesn't matter whether or not shorting a stock is ever something that you want to do or don't want to do. But it's just a way to provide a little bit of context for when you would actually want to buy a put, which is one way to take advantage of a falling market without having to mess with margin and interest and unlimited risk, etc. So, and I bring this up, I spend a little bit of time here on puts because for stock traders who are looking to be able to not necessarily use options to speculate for profits, but are trying to use options in some of the same ways that an institutional investor would use options to protect their portfolio, to remove risk, things like this. The puts are actually very commonly used for exactly those purposes. So we'll be spending a lot of time on specifically that kind of a strategy as we start getting into some more of the material. So takeaway here is calls and puts. We're buying calls when we think that the market is going to rise, and we're buying puts when we think that the market is going to drop or when we think that the risk of a drop is high. Well, I mentioned in the last video that calls derive their value because they essentially convey a right to you, or they give a right to the buyer. So what exactly is that right? What is that value that we're dealing with? The rights are very similar but opposite, kind of mirror images of each other depending on whether you're buying a call or a put. So let's talk about this in a very simple generic example. So we're going to look at calls first and think about what are the rights that we're actually buying with a call and what are the rights that we're buying if we're buying a put. So let's say, for example, that we're looking at a call on stock ABC. Now, stock ABC currently is priced at $50. And you, as an investor, let's say that you're bullish on this particular stock and you think, well, there is probably an opportunity here for me. I could either buy the stock for $50 a share, or I could buy a call option on that stock. What a call option does is it gives you the right to buy the stock for a fixed price in the future. So, for example, we could buy a call that gives you the right to be able to buy ABC at $50. Now that option may cost you, let's say, $2. There will be a price associated with to buy this option. It's the same kind of thing as if you were buying a contract to be able to buy a house sometime in the future. If that option is going to cost you $2 per share to be able to buy that right to buy that option, you may automatically ask, well, why would I buy the right to buy a $50 stock for $50 and spend $2 to do it? Why wouldn't I just buy the stock itself? Well, it's really a function of leverage. So that's one of the greatest things about options, is that they provide leverage that's ultimately within your control as to how you manage that leverage, how much you want to turn up the profit opportunity in exchange for risk, or how much you want to turn that down. But let's look at an example. Let's say that this stock subsequently goes up to $55. Well, that's a $5 profit if you just purchased the stock, so that's pretty good. So you've made $5 if you had just purchased the stock, 10%, not too bad at all. But if you had bought that call, so in this case, what you did was you bought a call, which gave you the right to buy the stock for $50. Well, it's now worth $55. So what has happened to the value of this call? Well, you have the ability to exercise it for $50. So you've accumulated that same profits, those $5, and it cost you $2 to do it. So instead of making 10%, you've made 150%. So not too bad. And as you can see, that's exactly what leverage does. Leverage is the ability to increase those returns in exchange for risk. And we're going to start talking about some of the risks and rewards of options as we continue to go through these sections. The takeaway in this particular video is, what are the rights that you're buying? It's very similar to how the puts work. So for example, let's imagine that you have a stock here, XYZ. And XYZ is also worth $50 a share. Now XYZ, however, you are not optimistic about its prospects, and in fact would like to find an ability or find a way to profit from a decline in that stock. Well, you could certainly short it, but that comes with a whole series of complexities that you may not want to deal with. So you could buy a put. Now the put conveys the right to sell the stock for a set price in the future. So in this case, you buy a put that gives you the right to sell the stock for $50 in the future. Well, subsequently, and let's say that that particular option costs you $2 per share. Well, subsequently, the stock in fact does fall, goes all the way down to $45. And which is a decline of $5, but what do you have the ability to do? You have the ability to sell a stock that is currently worth $45 for $50 because you bought the right to do that previously or before the decline. So that turns into, you get to keep that difference. So that's a $5 difference for which you paid $2 to be able to do that. So the advantage here, once again, is what did we make from this particular trade? We made 150%. So these numbers aren't exactly coincidental. I kind of designed a very basic example. We're going to be going through case studies where we look at actual stocks and we try to figure out what's the best play here. What is the best way to use options? Because once we understand the rights that are actually given with each of these option types, we can determine, well, is there an opportunity for us to speculate and make some profits? Or do we want to use some of these options to hedge against some risk, which is something we're going to be talking about very quickly.